Hey friends, have you ever heard investors talk about the yield curve and wondered what on earth they're talking about? Or maybe you've seen headlines about an inverted yield curve signaling a recession. Well, today we're going to break this down in simple terms that anyone can understand. Stick around because this knowledge could help you make smarter investment decisions across bonds, stocks, and even currencies. Welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, retirement planning, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 700 videos with more than 300,000 watch hours as of December 2024. And today, we're diving into something that might sound boring, but is actually super important: the yield curve. Let's start with the basics. A yield curve is simply a line that shows the interest rates of bonds with equal credit quality but different maturity dates. Think of it like this: if you lend money to the government for different lengths of time, you'd expect different interest rates, right? That's what the yield curve shows us. The most common yield curve that financial news talks about is the one for U.S. Treasury bonds. It compares yields for 3-month, 2-year, 5-year, 10-year, and 30-year government debt. The Treasury Department updates these rates every trading day by 6 p.m. Eastern Time. But why should you care about some line on a graph? Because this line can actually predict where the economy is heading. The shape of the yield curve gives us clues about future interest rates and whether we might be heading for economic growth or a recession. Have you ever wondered how the pros seem to know what's coming next in the markets? Well, the yield curve is one of their secret weapons, and today I'm sharing it with you. Normal yield curve. A normal yield curve slopes upward, meaning longer-term bonds have higher interest rates than shorter-term ones. This makes logical sense, right? If you're locking up your money for 30 years instead of 2 years, you'd want a higher return. A normal curve suggests stable economic conditions and healthy growth ahead. For example, you might see a 2-year bond offering 1%, a 5-year at 1.8%, a 10-year at 2.5%, and a 20-year bond at 3.5%. That steady climb as the time gets longer is the normal pattern we expect to see. Imagine a graph where the x-axis shows time, from 3 months to 30 years, and the y-axis shows yield percentage. A normal yield curve would look like a smooth upward slope from left to right, starting low and gradually climbing higher as the maturity increases. Inverted yield curve. Now here's where things get interesting. Sometimes the yield curve flips upside down, with short-term bonds having higher yields than long-term bonds. This is called an inverted yield curve, and it's pretty rare. But when it happens, pay attention. An inverted curve has historically been a warning sign of an upcoming recession. Why? Because investors are rushing to buy long-term bonds, driving their prices up and yields down. They're essentially saying, I think interest rates are going to fall in the future because the economy is going to slow down. If we visualize this on our graph, an inverted yield curve would slope downward from left to right, with short-term yields higher than long-term yields, the opposite of what we normally expect to see. Flat yield curve. The third type is a flat yield curve, where there's little difference between short-term and long-term rates. For instance, a 2-year bond might offer 6%, while a 20-year bond offers 6.05%. This usually signals uncertainty in the market. Investors aren't sure which way things are heading. On our graph, a flat yield curve would appear as an almost horizontal line across different maturities, showing similar yields regardless of time commitment. Think of the yield curve like a mood ring for the economy. Normal curve, the economy is feeling good. Inverted curve, the economy might be getting sick. Flat curve, the economy is confused about how it's feeling. Why is the yield curve such a good recession predictor? Here's where things get really fascinating. The yield curve has been one of the most reliable predictors of recessions in the United States. But why? When investors expect tough economic times ahead, they often move their money into safe long-term government bonds. This increased demand pushes the prices of these bonds up and their yields down. At the same time, if the Federal Reserve is raising short-term interest rates to fight inflation, short-term yields go up. The result? An inverted yield curve. It's like watching birds fly inland before a storm hits. The birds, investors, sense trouble coming and seek shelter, long-term bonds. If you see this happening, you might want to prepare for economic rain. But here's an important point. The yield curve doesn't cause recessions. It just reflects what investors collectively think is coming. It's like a poll of the market's expectations about future economic conditions. Have you ever noticed how sometimes everyone in a room can sense a change in mood before anything is said? The yield curve works kind of like that for the economy. How to use the yield curve for investment decisions. Now let's talk about how you can actually use this information in your investing journey. For bond investors, if you invest in bonds, the yield curve can help you decide which maturities to buy. Some bond investors use a strategy called riding the curve, where they buy longer-term bonds and sell them as they approach maturity, hopefully capturing price gains along the way. When the yield curve is steep, normal, this strategy can work well. But when it's flat or inverted, you might want to rethink this approach. For stock investors, the yield curve matters for stock investors too. If the curve inverts, it might be signaling that a recession is coming in the next 6 to 18 months. Historically, stock markets can continue rising for a while after an inversion, but eventually they tend to fall as the recession hits. This doesn't mean you should sell everything at the first sign of an inverted yield curve, but it might be a good time to review your portfolio. Make sure you're diversified and perhaps get a bit more defensive in your positions. For currency traders, in the forex market, yield curves help traders understand interest rate expectations, which directly impact currency values. Currencies with higher interest rates tend to be more attractive to investors because they offer better returns. For example, if the US yield curve suggests rising interest rates while Japan suggests falling rates, traders might buy the US dollar and sell the Japanese yen, expecting the dollar to strengthen. Some forex traders even use a strategy called the carry trade, where they borrow in a currency with low interest rates and invest in one with high rates, profiting from the difference. Does this sound like something you might want to try? Let me know in the comments. Real-world example. The 2019 yield curve inversion. Let's look at a real example. In 2019, the yield curve inverted, with the 10-year Treasury yield falling below the 2-year yield for the first time since 2007. Financial news outlets went crazy with headlines about a coming recession, and guess what happened? In 2020, we did enter a recession, though it was triggered by the COVID-19 pandemic, which nobody saw coming. This shows that while the yield curve is a powerful tool, it can't predict specific events that might cause economic downturns. The yield curve is like a doctor who can tell you that your lifestyle puts you at risk for health problems, but can't predict exactly when or why you might get sick. Common misconceptions about the yield curve. There are some things people get wrong about the yield curve that I want to clear up. First, an inverted yield curve doesn't guarantee a recession. It's a warning sign, not a certainty. There have been false alarms in the past. Second, there's no single definition of which bond maturities to use when talking about inversion. Some analysts look at the 10-year versus 2-year spread, while others prefer the 10-year versus 3-month. Third, yield curve inversions don't cause recessions. They just reflect market expectations. The actual causes of recessions are usually more complex, involving multiple economic factors. It's like how a barometer dropping doesn't cause a storm. It just indicates that conditions are right for one to form. How central banks influence the yield curve. Central banks like the Federal Reserve play a huge role in shaping the yield curve. When the Fed raises or lowers its benchmark interest rate, it directly affects short-term yields. The Fed can also influence longer-term yields through policies like quantitative easing, where it buys long-term bonds to push their yields down. This is why it's important to pay attention to what central banks are saying and doing. Their policies can sometimes distort the yield curve's natural shape and its predictive power. Think of it like this. The yield curve is trying to tell us something about the economic weather forecast, but sometimes the Fed is like a weather modification program that's actively trying to change that forecast. Practical tips for using yield curve analysis. If you want to incorporate yield curve analysis into your investment strategy, here are some practical tips. Check the current yield curve regularly. The US Treasury website publishes this data daily. Pay attention to changes in the curve's shape over time, not just whether it's inverted on a given day. Combine yield curve analysis with other economic indicators like GDP growth, unemployment rates, and inflation data for a more complete picture. Don't make drastic investment decisions based solely on the yield curve. Use it as one tool in your broader analysis. Remember that different countries have their own yield curves, which may behave differently from the US curve. Would you like me to do a follow-up video on how to access and interpret yield curve data from different countries? Let me know in the comments. Yield curve strategies for different market conditions. Let's talk about specific strategies for different yield curve environments. During a normal yield curve, consider longer-term bonds for higher yields. This is the time when traditional bond laddering strategies work well. You can maintain a balanced portfolio with growth-oriented stocks since economic conditions are likely stable. If you're into currency trading, look for carry trade opportunities in forex, where you can take advantage of interest rate differentials between countries. During an inverted yield curve, consider increasing allocation to defensive stocks like utilities and consumer staples. These tend to weather economic downturns better than cyclical stocks. Short-term bonds might offer better yields than long-term ones, so adjust your bond portfolio accordingly. Take time to review your portfolio for companies that might struggle in a recession, especially those with high debt loads. If you trade currencies, consider hedging strategies in forex markets, as volatility often increases during economic transitions. During a flat yield curve, diversification becomes even more important during periods of market uncertainty. Focus on looking for value in individual securities rather than making broad market bets. For forex traders, consider relative value strategies, comparing yield curves across different countries to find opportunities where markets might be mispricing future interest rate movements. Remember, the goal isn't to time the market perfectly, but to adjust your strategy based on changing economic conditions. The limitations of yield curve analysis. While the yield curve is a powerful tool, it's not perfect. Here are some limitations to keep in mind. Central bank interventions can distort the natural shape of the yield curve. When central banks actively buy or sell bonds to implement monetary policy, they can artificially influence yields in ways that reduce the curve's predictive power. Global factors can influence domestic yield curves in ways that weren't as common decades ago. International capital flows can push yields in directions that have little to do with domestic economic expectations. The timing between an inversion and a recession can vary widely. Sometimes it's months, sometimes it's over a year. This makes it difficult to use for precise market timing. The yield curve doesn't tell you how severe a recession might be, just that one might be coming. It's a binary signal rather than a measure of magnitude. It's like using a compass for navigation, extremely useful, but you still need a map, knowledge of the terrain, and awareness of weather conditions to reach your destination safely. Conclusion: making the yield curve work for you. So there you have it, the yield curve demystified. This powerful economic indicator might seem complex at first, but it's really just showing us what investors collectively think about future interest rates and economic conditions. Whether you're investing in bonds, stocks, or currencies, understanding the yield curve can give you valuable insights into where markets might be heading. It's not about making dramatic moves based on a single indicator, but about incorporating this knowledge into your broader investment strategy. Remember, a normal curve suggests economic growth. An inverted curve often signals a potential recession. A flat curve indicates uncertainty. I hope this helps you feel more confident when you hear financial news talking about the yield curve. Knowledge is power, and understanding this concept puts you ahead of many investors who ignore these signals. What do you think? Will you start paying attention to the yield curve as part of your investment research? Let me know in the comments below. And if you found this helpful, please hit that like button and subscribe for more investing insights. Next week, I'll be talking about how to build a recession-resistant portfolio, which is a perfect follow-up to today's topic. This is Iggy from the Investing Iguana, helping you navigate the financial jungle. See you in the next video.